Many people today remain clueless about the true impact of the dot-com bubble, and it's not surprising. For many of us who were growing up around the turn of the millennium, our main focus was on things like video games, like the Nintendo 64, and we didn't fully grasp the magnitude of the financial events unfolding around us. If you're like me and want to understand more about this critical moment in history, I suggest you keep watching this video. And don't forget to like the video and subscribe to our channel for more insights on the fascinating twists and turns of financial history. Let's dive deeper into the dot-com bubble, which occurred during the late 1990s and early 2000s. This was a period of extreme hype surrounding online companies, leading to a financial crash that impacted millions. Today, when people think about the dot-com bubble, companies like eBay and Amazon often come to mind. But to fully understand how we got to that point, we need to step back and examine the timeline. Starting in the early 90s, the internet began gaining serious traction in January 1993 with the introduction of Mosaic, a groundbreaking web browser. Mosaic made the internet more accessible to the masses, transforming it from a niche network of connected computers into something that could be used by everyday people. This was the beginning of the public internet. Developed by Eric Bina and Mark Andreessen for the National Center for Supercomputing Applications, Mosaic opened the door for other browsers to compete in what became known as the browser wars. Before the rise of Mosaic, the internet was still a realm for tech enthusiasts, mostly people who worked with computers or enjoyed exploring network systems. The early internet was not user-friendly by today's standards. But with the advent of Mosaic, the internet was now something the average person could access, making it the first true step toward mainstream adoption. Andreessen, who co-founded the firm Andreessen Horowitz, a major venture capital firm that has invested in companies like Skype, Twitter, and Facebook, was key to this transition. Their investments in tech companies later helped reshape the online landscape. The 1990s also saw the rise of competing web browsers, each vying for dominance in a rapidly expanding market. But this was also the era of the modem, where internet speeds were incredibly slow by today's standards. Back then, the fastest modem speeds were only 56 caps. Downloading a 1 gigabyte file would take you about 42 hours. Even when 256 kilobytes connections began becoming available, they were still very slow and prone to frequent disruptions. However, despite these limitations, the internet's growth was unstoppable. Between 1984 and 2000, the number of U.S. households with personal computers rose dramatically, from just 8% to over 51%. Entrepreneurs started seeing the internet as a new business frontier, which led to a surge in the number of websites. In 1996, 257,601 websites were uploaded to the web, a 996% increase from the previous year. With the launch of major search engines like Yahoo and the increasing popularity of the internet, it seemed as though the internet had become a gold mine. Even though I was alive during this revolutionary time, I admit I was too distracted by other things to fully appreciate what was unfolding. The internet was no longer just the domain of geeks in dark basements. By the late 90s, it was mainstream, and companies were quickly jumping in, hoping to cash in on the next big thing. It wasn't just about making great products. It was about attracting users as quickly as possible. But here's an important turning point in this story. Netscape, one of the first popular web browsers, went public on August 9, 1995. This was a monumental moment in internet history. Netscape's IPO price was set at $28 per share, but the price nearly tripled to $75 before closing at $58. The founders of Netscape went from being worth nothing to having a combined net worth of nearly $2.9 billion in just a few months. Netscape's meteoric rise caught the attention of investors, fueling even more hype around the internet. With the success of Netscape, investors began believing that any company with .com in its name was bound to succeed. No longer was profitability the primary focus. Growth was everything. By 1999, there were 457 .com companies that went public. IPOs in that year were particularly lucrative. In 1996, the average first-day return on IPO was 17%, but by 1999, the The dot-coms saw returns as high as 439%. These companies raised an enormous amount of capital, over $34 billion between 1995 and 2001. This period was marked by a few key factors, including the lowest interest rates since the 1970s. Investors were more interested in the potential for rapid growth than the profitability of companies. They wanted to get in early, believing they could cash in once these companies grew into giants. Even though many of these companies were losing money, they spent freely, focusing entirely on user acquisition rather than generating profits. This pattern of reckless spending is eerily reminiscent of today's tech world, where companies often prioritize growth over sustainable business practices. At the time, Federal Reserve Chairman Alan Greenspan warned that this spending was unsustainable. However, his warning was largely ignored by investors who were caught up in the excitement. By 1999, the speculation reached a fever pitch. Everyone believed that the internet would forever change the way we did business. The term irrational exuberance was coined to describe the overly optimistic sentiment that prevailed during this time. But as the saying goes, what goes up must come down. The reality of the situation began to set in. While companies like eBay and Amazon thrived, the majority of dot-com businesses failed. In 1999, for instance, Pixelon, a streaming video company, threw an extravagant party featuring bands like Kiss and Sugar Ray, epitomizing the kind of over-the-top behavior that had become the norm during the bubble. But reality soon hit. Overspending on marketing and other non-revenue-generating activities wasn't sustainable. The first cracks in the bubble appeared as companies continued to raise their valuations to unrealistic levels. The dot-com companies were pressured to grow at an astronomical rate. For instance, it was estimated that a company would need to increase revenue by 80% each year to meet the insane valuations placed upon them. The reality was, even the biggest companies like Microsoft were only growing at about 50% annually. March 10, 2000 marked a pivotal moment. The Nasdaq reached its all-time high of 51,3252 points, but the dot-com bubble was beginning to deflate. A series of events in early 2000 began to shatter the illusion of endless prosperity. On February 2000, Alan Greenspan raised interest rates, warning of an overheated economy. It wasn't long before the U.S. government also took steps to rein in the speculative behavior. However, the impact on the dot-com market was inevitable. 3 days after the Nasdaq's peak, Japan entered a recession, which set off a chain reaction that saw the global stock markets plummet. The dot-com crash began in earnest. By the end of 2000, the Nasdaq had lost nearly 40% of its value. The dot-com companies that had once been the darlings of Wall Street were now seeing their stocks plummet. The financial collapse hit hard, with over $1.75 trillion lost in tech stocks alone. By November of that year, companies like Amazon saw their stock prices drop from $107 to just $7, and Apple saw a similar drop, going from $5 per share to just $1. Despite the widespread destruction, some companies did survive the crash, most notably Amazon and Apple. These survivors managed to weather the storm due to their solid business models and strong leadership, which allowed them to eventually rebound and grow into the tech giants we know today. But the lesson from the dot-com bubble was clear. Without a sound business model and the ability to generate profit, even the most hyped companies can crash and burn. So who is responsible for the dot-com crash? In retrospect, many analysts, including Alan Petrikov, chairman of a New York investment firm, believe that the blame falls on the capital markets. These markets pumped vast amounts of money into speculative companies, ignoring the fundamentals of good business practices. The greed-driven frenzy of advertising and the abandonment of sound business models contributed to the collapse. As Petrikov and others pointed out, the capital markets had mismanaged the money that was supposed to be used to support sustainable businesses. The aftermath of the dot-com crash left many wondering if the global economy would ever recover. And now, in the 2020s, analysts are warning that we may be facing another recession that could rival the one caused by the dot-com bubble. The lesson here is clear. Speculation and unchecked enthusiasm can lead to massive financial consequences. I hope this video gave you more insight into the dot-com bubble and what we can learn from it. History has a way of repeating itself, so it's essential to understand these events to better prepare ourselves for the future. Thank you for watching, and remember to leave a like and subscribe to our channel. Stay tuned for more videos, and I'll see you in the next one.